After asset allocation, the next step is to select the investments that are going to meet each quote unquote bucket that you've decided to have in your mix. So for example, stocks. If you decided to have 50% of your money in the stock market, which individual stocks are you going to pick? Which individual stock mutual funds or different things like that. So I think this step is important. As I mentioned before, the most important step is asset allocation, but this is also something to consider very seriously. So how do you think about this? Well, there are two main issues when making this decision. Number one, do you want to bet against the markets or do you want to bet with the markets? And the second issue is, do you want to do this yourself or do you want to outsource it to other people? So in this tutorial, I just want to give an introduction to the concept, give you an example so you can build that intuition of how to think about this step two of selecting investments. So let's think about the stock market, your stock allocation. Let's just say you decided to put 100% of your money in stocks. How do you think about this first issue of betting with the market or against the market? Well, let's think about it this way. The world stock market is a sort of a voting machine. Every day that the markets are open around the world, investors go out and cast ballots. They vote on which companies will get their money and which companies do not. And the end result is a world stock market index by market cap. And I want to show an example of the second quarter of 2014, what that looks like during this time period. And it doesn't change too drastically over time. So the world stock market in the second quarter of 2014 returned a positive 5.1%. Just want to show you for illustration purposes. But what's important is what the composition of that market looks like. And what we see here is that investors have voted that about half of the money that's available for publicly traded stocks in the world should go to the United States. And about 9-10% should go to emerging markets, and about 40% should go to developed markets. Now, is that right? Is that wrong? Who knows, right? Is it properly valued? There's a lot of questions here, but the bottom line is this is what the aggregate of all investors participating in this market say. So that is in essence, the location of where things sit, and if your portfolio, if the investor's portfolio looks different from this split in terms of location, then you are betting against the market. If it looks similar, about half of your money in the US, half in international, then you're not taking a location bet. You're not betting, you're betting with the market. Let me look at it from a different perspective. Let's think about size and style, which are factors commonly used in investment to drive investment return. So what the world stock market tells us is that 76%, about 3/4 of the companies that receive money from investors are large companies. These are multi-billion-dollar companies like Google and Apple, and the rest of it goes to mid-size and small size. So again, if your portfolio looks different, if you're betting 100% of your money in small companies, then you're betting against the market, which could be right, could be wrong, but just something to be aware of. Same thing with style, right? About a third in value, a third in growth, and the rest is kind of core blend. Again, if you're a believer in growth stocks, tech stocks, and 100% of your money is in growth stocks, then you are taking a huge bet against what the world stock market aggregate investor base is saying. Sectors is another way to consider it. This is how it breaks down by sector. Energy makes up about 10%. I know a lot of my friends that work in oil have 50, 75% of their money in energy stocks because they feel like they know that sector well. Well, if you have 100% of your money in energy, what you're saying is that the world stock market is wrong and that you're right by plus 90%. You might be right, you might be wrong, but it's something to be aware of. I want to talk about fees because that's an important topic when selecting investments. And I don't believe it's well appreciated in the world of financial services. what the impact of fees are. Let me give you an example of that. If you invested about $99,000 for over 30 years, your ending wealth would be about $1 million if you earned 8%. This is what the historical U.S. stock market has returned, absent fees and taxes and other things. So the question is, how would fees impact your ending wealth? Well, if you look at this chart, if you had a 0% annual fee, you would get your $1 million. However, it is impractical, impossible to participate in the finance world free of charge. You have to pay something, even if you do everything yourself. So just the question is, how do you manage those fees? Well, if you paid a 2% fee, annual fee, to have someone manage your money, to have mutual fund providers invest on your behalf, whatever that may be, it doesn't really matter how you paid the fee, you would end up with about half of your ending wealth. So fees are a huge deal. Even the seemingly small 2% a year in fee incurred really destroys value for the investor, and it's something to be aware of, to manage, and to understand that although you have to pay something, you have the ability to really minimize this effect and this amount that you're paying. I want to talk about fees from a different perspective. There are two types of ways to invest in the market. You can be an active investor or you're a passive investor. Basically, if you're an active investor, you are trying to select a few from a subset, from a large universe, in hopes of beating the entire universe. And what do I mean by that? Well, let's just say you believe in an ability to pick the best U.S. large value stocks. Well, if you're doing that, you should compare yourself against what the return of all U.S. large value stocks are. And that's the way to think about active versus passive management. Here's an example. We have the JP Morgan Equity Income Class A. This is the symbol OIEIX. That is an example of an active manager who is out there trying to pick the best U.S. large value stocks from this subset of all U.S. large value stocks. So what should JP Morgan, what should that team be compared to? It shouldn't be, did they make money? Was it positive? Was it negative? A more complete analysis is, did they beat something like the iShares Russell 1000 value, which is a company that's going out there and selecting all large U.S. value stocks. So that's the right comparison. And you can see here, I've added the fee that the JP Morgan folks charge, about 1%, and the fees that the iShares BlackRock charges is 0.21%, nearly 5 times less compared to JP Morgan. And why? Because the JP Morgan folks need a big team. They need a sophisticated process to go out and try to identify what are the best U.S. large value stocks.